Dear students of the School of Business and the viewers, Assalamu alaikum. I welcome you all today in our program. This program has been designed specially for the students of Commonwealth Executive MBA and MPA program and for the students of regular MBA program. However, the students of postgraduate diploma in management program will also be benefited. The topic CVP analysis emphasizes on cost structure and profit stability is related to SIMBA-SIMPA course Accounting and Finance CORE-1604 and MBA course Management Accounting MBA 3309. Cost volume profit analysis is frequently used by the managers as a management tool that answer many different questions. Managers always want to achieve the target level profit. At the same time, they want to make sure how many units to be produced and sold that will cover the cost for the organization. It also helps the managers to answer many different questions. For example, if the sales price per unit, variable expenses per unit, or the production and sales volume changes, and if the total cost changes, how the profit of the organization will also change. This is how the CVP analysis is also called the what-if analysis. At the very outset, let us see what are the objectives of today's program. The objectives are: understand how CVP analysis is used as a management tool, know what is cost structure, how the profitability of the organization is related to cost structure, what are the factors affecting the decision of choosing the cost structure, how change in sales affect the profitability of an organization given two different cost structure, and what is degree of operating leverage and how it helps managers to calculate the projected profit when sales increases or decreases. Dear students, you already know that there are some underlying assumptions for the CVP analysis. One of the assumptions of CVP analysis is that cost is classified into cost according to cost behavior, that is fixed cost and variable cost. Fixed cost remains same with the change in the level of output. However, variable cost changes with the change in the level of output. Now let us know what is meant by cost structure. Cost structure refers to the relative proportion of variable cost and fixed cost in an organization. For example, out of the total cost, the 30% can be variable cost and 70% can be fixed cost, or vice versa. Now the question is, which organization is better? Is the organization with higher fixed cost and lower variable cost is in better situation, or the organization is higher variable cost and lower fixed cost in better situation? There is no single answer. If the manager has some latitude in trading off between fixed and variable costs, which cost structure is better? That depends on many different factors. For example, long run trend in sales, year to year fluctuation in the level of sales, and the attitude of the owners towards risk. To understand the situation, let us consider the income statements for two different companies. Company A's sales revenue is $100,000, which is 100%, and Company B's sales revenue is $100,000. Company A's variable expenses are $60,000 and fixed cost is $30,000. So Company A's fixed cost is less than variable cost. On the other hand, Company B's variable cost is $30,000 and fixed cost is $60,000. That is, Company B's fixed cost is higher than variable cost. However, the profit for two organizations are same, that is $10,000. What will happen if the sales increases by 10% for both the companies? Look at the new income statement. If sales increase by 10%, what will happen? Total sales amount will be $110,000. Contribution margin is 40% and variable expense is 60% for company A, and for company B contribution margin is 70% and variable expense ratio is 30%. So, we will use the same contribution margin and variable expense ratio. Variable expense for company A is 66,000 and fixed cost will be same, which is $30,000. For company B, the variable expenses will be $33,000 and fixed cost is $60,000. As a result, the net income of company A is $14,000 and company B's net income will be $17,000. Now, if you analyze the two income statements, you can understand that when sales increases by 10%, profit for company A will increase by 40%. That is, earlier their profit was 10,000 and now it is 14,000. So, their profit has been increased by 40%. On the other hand, organization B, whose fixed cost is higher than variable cost, their profit has been increased by 70% for only a 10% increase in sales. Now, if you consider the situation that when the sales are decreasing by 10%, what will happen? The total sales revenue for both the cases will be $90,000. Variable expense for company A will be $54,000. Fixed cost will remain same, that is $30,000. So, net income is $6,000. For company B, the total sales $90,000. The variable expenses is $27,000. As a result, the net income will be $3,000 for company B. Dear students, we have considered two different scenarios. That is, when the sales will increase by 10%, what will happen for two different type of organization. At the same time, when the sales will decrease by 10%, how the profit will change for two different type of organization, that is organization with two different cost structure. Therefore, we can safely state that company B is more vulnerable comparing to company A in relation to changes in the level of sales, and company B is risk taker whereas company A is risk averse. Company B will enjoy more profit than company A if sales increase. Company B's profit will sharply decline comparing to company A's profit if sales decreases. Dear students and viewers, now you can understand that when the management is considering the case of shifting in between the cost structure, especially when they are thinking to move from variable expenses to fixed expenses, they must be very much careful in making their decision. That when an organization invests a huge amount in their plant machineries and equipment, they must make sure that they will be able to expand their market share, because as there are a lot amount invested in the fixed cost, the organization must try to expand or increase their market share. At the same time, they must be very much careful about the quality of the product. They have to think about whether the product will be obsolete or not within very short time, because again, if the product obsoletes, then they will suffer a huge amount of loss. So again, it depends on many different factors what type of cost structure the organization will follow. That is the attitude of the management towards risk and the condition of the sales, that is whether the organization will be able to increase their sales or enhance or expand their market share or not. Now let us look at the break-even point of two different organizations. Organization B's fixed expenses are more than organization A. That is why their sales must also be higher to cover the extra amount of fixed cost. Dear students, you know how the break-even point is calculated in dollar amount. Break-even point in dollar is a ratio of fixed cost and contribution margin ratio. For company A, the break-even point in dollar is $30,000 divided by 40%, which is $75,000. For company B, the break-even point is $60,000 divided by its contribution margin ratio, which is 70%, that is equals to $85,714. So, company B's break-even point is higher than company A's break-even point. Now I will discuss a different topic which is also related to CVP analysis and cost structure, that is degree of operating leverage. The term operating leverage is a measure how sensitive the net income is with change in the level of sales. That is, when the sales increases or decreases, that is the change in sales is expressed as a percentage form, then we can use the degree of operating leverage as a multiplier. That is, without preparing an income statement, it is possible to say right away to what percentage the profit of the organization will increase or decrease with a certain percentage increase or decrease in the level of sales. Now let us see how the degree of operating leverage is calculated. The degree of operating leverage is a ratio of contribution margin and net income. Students, you must always remember that degree of operating leverage is a multiplier, so it must always be expressed in a digit or whole number. It is not expressed in a percentage form. Now let us see how the cost structure is related to the degree of operating leverage. Organization with higher variable cost will have lower amount of contribution margin, because you know that contribution margin is the difference between sales and variable expenses. So organization with higher variable cost, their contribution margin will be lower, so their degree of operating leverage will also be lower. At the same time, organization with lower variable expenses, they will have an higher amount of contribution margin, so their degree of operating leverage will also be higher. Now let us look at the situation of company A and company B as we have discussed earlier. The degree of operating leverage as a multiplier is calculated as a ratio of contribution margin and net income. When the total sales is $100,000, the degree of operating leverage for company A is $40,000 divided by 10,000, that is 4. The degree of operating leverage for company B is $70,000, that is their net income, divided by contribution margin divided by their net income, which is $10,000, that is 7. Since the degree of operating leverage for organization A is 4 and the degree of operating leverage for company B is 7, as their sales increase by 10% for both the cases, company B's profit will increase by 40% and company B's profit will increase by 70%. Now let us see what is the use of degree of operating leverage. When sales increase by 10% without preparing an income statement, it is possible to say to what percentage profit will increase. That is, as we multiply the percentage increase in sales, that is 10%, by the degree of operating leverage, that is 4, the increase in profit will be 40% for company A. For company B, when sales increase by 10%, and we already know their degree of operating leverage is 7, and as we multiply them, the profit for company B will increase by 70%. Again, if sales decrease by 10%, in the original situation our total sales was 100,000 and net profit was 10,000 for company A. When sales decreases, the profit decreases to $6,000. And we know that the change in sales, that is 10% decrease multiplied by 4, so profit decreases by 40% here. For company B, the sales decreases by 10%, that is from $100,000 it is now $90,000. So 10% is the decrease in sales, which should be multiplied by their degree of operating leverage, which is 7. So the decrease in profit is also 70%. So this is how the degree of operating leverage as a multiplier helps the management to calculate to what percentage their profit will increase or decrease with a change in sales, when the change in sales is expressed as a percentage form. So this is also used by the managers as a management tool. Dear students, let us have a quick review what we have learned from today's program. We have discussed about the CVP analysis, cost structure and their effect on profit stability. We have also discussed about degree of operating leverage and how it is also related to the cost structure of an organization. Degree of operating leverage as a multiplier helps the manager to make decision or to find out right away how the percentage change in sales affects the percentage change in profit. So they can use the degree of operating leverage to make their decision as a management tool. Therefore, you can understand that when the managers are making their decision regarding the cost structure, they will think very carefully to shift in between, especially when they will shift from variable cost to fixed cost. Because once they invest a huge amount in their fixed cost, that is plant machineries and equipment, they have to make sure that they will be able to increase their sales. They have to think carefully to expand their market. They have to take many promotional activities. Otherwise, they will suffer a huge amount of losses. Dear students, we have discussed about the main concept of CVP analysis, cost structure and profitability and its relation with degree of operating leverage. Please read through the chapters for more details. I believe you have been benefited watching this program. Thank you very much for watching this program. No more today.